Wow, what a move in silver lately, right? It's been on an absolute tear. But after the last 24 hours, man, that volatility has a lot of people spooked. The big question on everyone's mind is the silver bull run over? Well, let's get into it and figure out what's really happening.
I mean, look at this. It was a complete roller coaster. The price took a nosedive, dropping from a high of $82 an ounce all the way down to $72. But here's the thing, and you got to put this in perspective. All that drop did was take us back to where we were last Wednesday. It basically just wiped out that one powerful rally we saw on Friday.
So this really gets to the heart of it, doesn't it? What really caused this crash? Was this some fundamental shift telling us the party's over? Or, and this is the interesting part, is this violent shakeout actually setting the stage for the next massive move to the upside? Let's unpack it.
Okay, to really get what's going on, you have to understand the two sides of silver. And first up is what we call the paper market. This is the playground for the big institutional traders, and it's the absolute key to understanding why the price dropped so fast.
See, you need to know that the big professional traders, they're not in a vault somewhere stacking actual silver bars. They trade paper silver, and they do it using something called a futures contract. It's basically just a piece of paper, an agreement to buy or sell silver at a set price in the future. Nobody's touching the physical metal. So you might be asking, why bother with these complicated things? Well, it all comes down to one magic and sometimes dangerous word: leverage. Just think about it. One single silver futures contract lets you control 5,000 ounces of silver. That's worth around $385,000. But the trader? They only have to put down about 22 grand in cash. That is insane 17-to-1 leverage. It means that 60% rally we saw, for them, that wasn't a 60% gain, it was a 1,000% gain.
But that leverage, it is a serious double-edged sword. Here's what just happened. The market got super volatile, so the exchange got nervous and they raised that cash down payment, the margin requirement, from $22,000 to $25,000. Now, traders who are maxed out on leverage, they don't have that extra cash. That triggers something called a margin call, and their broker has no choice but to force sell their positions immediately. It's like a domino effect of selling that just feeds on itself.
And this is the single most important thing to understand about that price drop. It was a technical event. It was all about the paper market, about leverage and margin calls. It had absolutely nothing to do with the real-world value of silver or some sudden change in its supply and demand.
Okay, so we've talked about the paper chaos. Now, let's switch gears and talk about the real world. You know, the physical stuff. Because while all that drama was happening on the trading screens, the story for actual physical silver was getting incredibly bullish.
This really kicked into high gear back in October. We got hit with this incredible 1-2 punch to the global supply. First, China says it's restricting silver exports. Then, just a week later, the US government officially put silver on its critical minerals list. That's a huge deal, and it signals a major geopolitical squeeze for the actual metal.
And you know who's noticing this? People like Elon Musk. And when he says the situation is not good, he's not worried about his investment portfolio. He's worried about being able to actually get the metal he needs to build things. It's about physical availability for crucial industries.
And if you want proof that this is about real urgent demand, just look at what happened on the Friday after Christmas. That day is usually dead quiet for trading. But this year, silver saw record-breaking volume. That's not speculators playing games. That's big players scrambling to get their hands on whatever physical supply they can find. All right, so let's take a step back. We've seen the short-term paper mess, and we've seen the real-world physical squeeze. What happens when we zoom way out and look at the really big picture for silver? Okay, check this out. This is a 50-year chart of silver. And what you're seeing here, this giant cup with handle pattern, is something that technical analysts get really excited about. It's a classic sign of a massive upward trend, and this thing has been building for decades. We're talking about a potential breakout from a 60-year pattern.
Now, let's talk about upside potential. How high could this thing go? Well, if silver just goes back to its old 1980 high when you adjust for inflation, that's a 152% gain from here. You compare that to platinum, which has about a 77% upside to its inflation-adjusted high. The bottom line? The math says silver has way more room to run.
And it's not just the charts, right? There are solid, fundamental reasons why silver looks like the stronger play. For one, pretty much everyone on Earth recognizes silver as money. Its market is also super liquid, so it's easy to get in and out. Its industrial uses are absolutely critical, with very few alternatives. And hey, just look at the last 5 years. It's been the clear winner. Okay, so that's a lot of information. How do you actually use this? Let's boil it all down to some key actionable levels that you're probably going to want to watch.
So here's the big idea, the whole thesis in a nutshell. All that chaos we saw in the paper market, that technical sell-off, it might just be creating an incredible long-term buying opportunity for anyone focused on the powerful story happening in the physical market.
You know, after a rocket ship move like we just saw, it's totally normal, even healthy, for the price to pull back and catch its breath. A lot of analysts are watching for a 50 to 61% retracement of that big rally. So doing the math, that puts a really interesting potential buying zone right in that $63 to $67 per ounce range.
And if you can navigate this volatility, what's the potential prize on the other side? Well, looking back at that huge 60-year pattern we saw, the long-term price targets it's pointing to are pretty incredible. We're talking $200, maybe even $250 an ounce, and some think it could go even higher.
So to wrap it all up, what we saw was a shakeout, a technical one, driven by leverage in the paper markets. It wasn't a change in the fundamentals. At the same time, the physical market is flashing all sorts of warning signs about a major supply squeeze. And this whole situation really forces us to ask a bigger question, one that every investor has to think about. In a world that's becoming more and more digital, what is the future role of these critical physical assets that you can actually hold in your hand?